Hey Chris, how you doing, man? Good morning.
Good morning, my friend. I'm very good. How are you?
Good, really good, man. Just taking in the change in seasons here. Is it it's a little chilly down here in Kentucky. So what's it like up there?
Oh man, you know what it's like in Canada. We had 3 days of beautiful weather, which was our fall. We're going to have about 2 days of summer in June, and the rest of the time we're going to be under an iceberg. You can see I'm indoors with interior heating. I've got a sweater on. It's sunny outside, and I think it's minus 400. I think
I
I'm not a very good person with cold weather.
I dislike the how can I say, the way nature is deceptive in the winter when you see the sun and you go outside and you're like, oh my God, it's cold. Got to go back in.
It's pretty much every day for me here. Look, it's beautiful weather. I'll be honest with you. When I was living in South Africa and they said, "Are you going to leave the country?" I said, "Yes, yes, yes. I'd love to leave the country." And they went, "Okay, well, where should you go?" And you got choices as an English-speaking South African, right? You got New Zealand, you've got Australia, you've got Canada, you've got the US, and you've got the UK. So you sort of go through the list. You go UK, too much rain, scrap. Australia, it's the arse end of the world, right? It's just far away from everything. New Zealand, it's the arse end plus a bit more. So no, no, right? So you leave those two out. So it leaves you now with the US and with Canada, and you go, US, it's hard to get in. It's hard to get in, right? So you sort of scrap that. And you go, okay, I'm going to go to Canada. And you go, okay, where do Canadians go on holiday? And they go, well, Mexico. It's only a short flight away. You go, short flight? That must mean that the weather is something similar, right? So you go, yay, Canada. And you sort of get here. And I remember landing here in the middle of February. I mean, February is just like, God's wrath. I mean, it's horrible. And I remember landing here and I'd never seen snow before. And I just sort of see this white stuff on the floor. And it's just, I had a torn shoe and all the snow is going into my shoe. And it was hard. It's been 10 years. It's been difficult. I can never get used to it.
Yeah, snow. I would rather it snow than just be cold, though. At least I don't know. I mean, unless the snow is so it just looks better. If it's the worst of all is like the really cold. I'm not gonna freeze, rainy, drizzle, slush.
Oh, that's horrible. And for us jiu-jitsu guys, because our joints are so sore from gripping gis all the time, you this humidity in the air starts to really affect your bones, especially at my age. So, for me, cold and humid, no, it's not a good combination. Not a good combination. So, but look, take the weather out. There's a lot to be thankful for up here. So, I accept it as the price of living here is you got to wear layers.
Yeah, everything's pros and cons. So the market looks pretty good, man. It looks like
It does. It does. I mean, I think over the last couple of weeks, particularly since around October 18, the market sort of shifted dynamics. That September, October period we knew was coming. It happened. It was pretty brutal, all right, for people that were involved in a lot of long call options. Yeah, it suffered a little bit. But the reversal that's happened since October 18 has made back on that and some more. Now we're at a point where it's like, okay, well, is this as good as it gets? Or is there more to come? And starting at the beginning of November, we enter into a period which, according to the seasonality in the history of the markets, this is the best 8 months ahead for NASDAQ and the best 4 months ahead for the market. So you've got to play the charts in front of you. I was talking to some clients the other day, and I said to them, you've got to be careful about bias and overemphasizing particular news points. Remember, you turn on the news, these guys want you to be anxious, right? That anxiety is a common emotion as a trader. Is it going to fall down? Is it going to go up? All of that stuff. You've just got to be really careful and just trade the charts in front of you. Don't get too wrapped up in, is it going to fall? Is it going to rise? Is it going to do this? Is it going to do that? Because no one really knows. And if these talking trash cans, I call them on TV, say things like, oh, market's going to go up, they don't have a clue. They really don't know any more than you do. So, I would just be very careful about overemphasizing certain news bites or sound bites and just trade what's in front of you. I mean, we went into some trades in October 18. It was the worst time. If you looked back over the days preceding that, it was a pretty bad time. But we had our signals, and we have a very strict way of operating when signals appear. So we had the signals, we enter on the signals, and I know that you've been seeing, we've had a couple thousand percenters, and we've had a couple of triples and quadruples over the last 2 weeks. So this is normal for this time of the year. If I look back, last year, this time, second week of expiration in November, we pretty much doing exactly the same thing that we did last year at this time. So I think it's great. Just be, you've got to trade carefully, as always. It doesn't really matter what's going on around you. Just trade carefully. Don't oversize. Don't have expectations that are unrealistic, because that will keep you in positions a little too long. Set your targets, manage your stops, keep your size the same, or keep it small, and just keep recycling. As long as you keep that thing in mind, you're going to make money. If you oversize and get greedy, it can be pretty painful. But we should expect the price to pull back compared to the market.
Are there different kinds of rallies that you've seen? I mean, are there different trajectories on rallies?
Yeah, there are different types of the year. Seasonality is, people sometimes put too much emphasis in seasonality. Seasonality for me is not a setup. You can't trade seasonality. You can't say, well, just because it did this, it's going to do it again. There's a certain element of what happened in the past may look something similar to what happens later on, right? It's not going to happen exactly the same way. There's a certain element of rhyming, right? It's like looking at history and saying, history repeats itself. Well, not always. What it does is it looks similar. It's, a similar scenario. So there are different kinds. You can sometimes see momentum rallies starting to build. You can see reversions to the mean, be it from underneath the mean back to the middle, or from the middle up to the top. They're slightly different. What you've got to watch though is volume. Momentum type movements, or any kind of rally that is done without volume, very, very key to watch that, because volume is a key driver of how strong will that move be, right? If you think about something, price goes up, but volume didn't go up at the same time. It means that price increase is not going to be sustained. People aren't going to support it. So when it pulls back, the buyers aren't going to be there to prop it back up, because they've already exhausted themselves, right? So when you start looking at the market dynamic, it's always this sort of war between the bulls and the bears, right? And sometimes the bears are going to be winning, and sometimes the bulls are going to be winning. And what we look for are certain signs that the bulls defend levels, right? So when the prices pull back to specific points, you want to see volume increasing at that price point. You want to see when that price comes down, you want to see the bulls come in and really back up that price and push it back up to the top. Those are very, very strong signs. When you see bulls are sort of sitting back, buying the dips, you can see when they come in. What's not good is when you see prices rising, but no buyers are coming in. That's when prices are going to start falling down. So that's why be careful about watching price by itself. It's something that I find has worked for me in my trading, and it might not have worked for others, but I find working with multiple indicators, looking at the same data, or not necessarily the same data, but the same result. I'm looking for the same answer, but I'm looking at it from multiple angles. The more confluence you get around indicators that are based on different pieces of data, the better the signals are going to be, the better the trade setup will be. So you can't just look at degrees of oversold and overbought, right? Because stocks can remain overbought for some time. So you have to look at overbought, oversold relative to the squeeze, all right? Sometimes the overbought, oversold can give you a leading indicator into where the squeeze is going to move. The same thing with our proprietary B score or our wave. That's how we look to see whether or not the squeeze is going to go up or down. Our alpha score gives us a bit more as well. So you've got to look at data from multiple sources. And when you've got 7 signals from different sources saying the same thing, that's when you've got a great setup. But if you're only trading on one single indicator, and that indicator is a lagging indicator, which means price has to form before the indicator can print, that's where you might have a little bit of a problem, because you're always going to be behind the curve. You've got to get ahead of the curve. You need to know where price can potentially move. It's always in trading about probabilities. What's the probability of the price moving up? You know, it could be a 5% probability, and you might be happy trading a 5% probability. So you've got to make sure that your rule sets and the system that you build has leading indicators. It can have lagging indicators, which can give you a degree of quality to the signal, but it shouldn't be your trigger. Your trigger should always be on the leading indicator. So that's something that you know, my guys learn. We build those systems together for them, and they tend to work. I can show you a couple of things here. This is just a very simple signal that we use. This is a price and momentum reversal signal. If you look at this green column over here, this prints in real time. It's a non-repaint signal, and this was a momentum reading, right? So we had a moving average cross together with a momentum reversal. On the confirmation candle, we had a price reversal, which meant that we had a very strong scenario building over here around October 14, October 15. Once the stock started to move into the Ichimoku cloud, this is the time to go long, right? So this is when we started building our positions in SPXL. So SPXL, you can see here we had, although we had a red candle, we had a price reversal, moving average cross together with our, a momentum reversal, and then we had the price reversal on the next candle. This was where we go long. And if you look at the leading indicators, our B score was a leading indicator to the reversal of momentum, and our alpha score was a confirmation signal on the price change. So you had three indicators all telling you around this cluster of price that things were starting to change. So this is when you've got to start acting based on your signals, because if you looked at this trend that formed here, all right, these yellow and red candles, this is where people sort of, you know, the market's terrible, man. Any kind of reversal to the upside is going to come down. You can short the reversal, right? So this is what they would have done. They would have shorted that reversal. They would have got successful. They would have shorted that. They would have been successful. 9 times out of 10, they would have gone, let's short that movement there. They would have shorted this instead of going long. And that's where the shorts get killed. So all the money that they make here, they lose over here. So this is why it's hard to sort of, you know, you've got to have a bias and wait for your signals to confirm the bias and then trade the bias. You can't go long and short at the same time. This is what I try and tell my clients is be careful about trying to time these. This is difficult. This is really hard trading. This is hard stuff. Because these bounces, these gaps up, these reversals to the mean, they can be pretty painful. If you've gone short on the wrong candle, let's imagine you shorted the market there. This killed you. This bounce here killed you.
Is that why you got to keep such a tight stop loss, mental stop loss on the short side plays?
Yeah, absolutely. And what happens is many traders still follow the same rules, right? So think about what happens. They short there. Let's say they shorted down here, okay? Somewhere at the bottom third of this candle. They shorted here. Most of them are going to have stops that are here. So they went in and lost money immediately. Then they went here. They shorted this. Their stop line was probably there. They got killed. They went short again, or they took their profits, shorted again maybe, and lost again. It's a very, very difficult thing to do. So what I say to guys is just don't do it, right? Just don't do it. Just rather sit here and be patient. Wait. Here was our first trigger for the long side. When the moving averages got crossed, there was our first trigger. So a really aggressive trader could have started building their position on this candle here, all right, with the moving average turned positive. It would have fallen back. They might have been able to add more, buy more. So depending on your plan. But it's really uncanny how accurate these signals can be, right? So now we're sitting in a situation where we're extended. We know we're extended. We can see the alpha score starting to dip. So it's dropping below 70. We have a stochastic sell signal. The squeeze momentum is still to the upside, but there's no squeeze, all right? So from here, we can anticipate a pullback to the mean, all right? So this is the 8-period moving average. We could pull back to the 21. How far that is, Okay, we'll have to work that out. But what you do is in your existing position. So we've got quite a few existing positions already on SPXL. So if we look at SPXL, we have a number of trades here. We've got stock, we've got call options, we've got, a spread. Our call options are up significantly. And what we do is we take profits from our option trades and buy shares. So we eliminate that theta risk. We eliminate the time decay risk on the trade because we know that this is staying in trend, right? So when we go back here, what we want to do is we want to keep lifting this, just keep raising your stop, right? So now if SPXL pulls back to that level there, I close down the position and I wait. I've taken my profits off the table. I wait. I will get a red column when the price crosses below the 8, and then I wait for another green column and I redo this entire process again.
So did you just set an alert? Is that an alert that you're moving and trading?
Yes.
Okay.
Yeah, this is just a trailing stop loss. So for each position that we have, you should have a stop loss position in or an alert. Now, for a stock that's in trend, I have no target to the upside. I don't know where this is going to stop. No one knows where it's going to stop. So rather than trying to say, right, I'm going to sell it at 148, let's say, that would be impractical because what happens if it gets to 148 and it just keeps going to 160, 170, 180? That wouldn't be right. So what you do is you just make sure that your stop loss, your line that will trigger a break in trend, I try and keep it as close to the short period moving average that I like to trade off, right? So I use the 8 pretty much quite, consistently. Some guys use the 5, some guys use the 16, some guys will use the 13. It really doesn't matter which number you choose. It's a question of how fast you want the signal.
The longer that moving averages are better for longer duration holds. Is that true, or?
Yeah, the longer the period of the moving average, the slower the signal, right? So if you're not sitting in front of your screen all day, you don't want to be getting SMS messages on your phone going, hey, get out of the trade, get out of the trade. You want to be able to come in at the end of the day, see where it is on the day candle, and then trade, put your order in the night before and walk away, right?
So what's a reasonable, I just had this question is what is a reasonable time frame? So we know that like if you're in front of the computer all day, you can day trade, you can swing trade, you can do pretty much any kind of trading. But like, let's say someone could only look at their computer at the end of the day, and occasionally they might even have to miss a day. What would be the time frame that they should probably trade in most successfully?
Oh, definitely the day charts.
Okay.
Definitely the day charts. And what you would do is you'd do something pretty similar to what we do here. So by and large, most of my clients are like that, right? They don't want to sit in front of the screen all day. What they want to be doing is other things that are far more exciting. So we trade the day chart. This is the one in the middle here, right? So you can see we've got Disney. I've got Disney up here. We've got a buy signal. We've got a buy, call, sell, put signal as well. It's trading slightly extended towards the second Keltner. It's just about to breach the top of the Ichimoku cloud. And you can see in the pre-market, it's already come back down. You can see how powerful this Ichimoku cloud is at pushing prices back down. So this is what we do. We look at the day chart and we take signals off the day chart, right? So we've got our buy signals here. We've got 1, 2, we've got 3 on chart buy signals. We've got our B score that's rising above 50. We have a squeeze firing to the upside. We have a stochastic sell signal, although it is moving. No, sorry, there's the buy signal. I couldn't see it for a second. There's our buy signal. Our alpha score is low. It's at 20. So this is a negative. All right. So because the alpha score is below 70, you have to take a little bit, you've got to be cautious here, right? If you're going to be trading Disney, your ultimate setup is going to be once it breaks above the Ichimoku cloud and closes above the Ichimoku cloud. So that would be the more conservative way to do it. But this is the day chart. When you trade the day chart, one of the important things to remember is you need support, right? So you need trade support on other time frames. So we look at the weekly and we go, well, what's the weekly chart doing? And you can see this sort of period of chop and consolidation that's sitting here. The trend is not up, it's sideways, right? So we see the stock moving sideways. It's not doing much. We've got a stochastic slingshot. We've got a long squeeze that's been building for a while. And our B score is still below 50. So we don't really have the same type of setup on the weekly chart, we've got negatives here. We've got a sell reversal here on price, and we've got a reversal on momentum. So we don't have as many good supporting setups here on the weekly chart as we have here on the daily. Now, if we decided we were going to day trade, or we were going to trade Disney, what we would be looking for is an entry on the hourly chart, right? So this is important, because here's the Ichimoku cloud that we see over here. I've just transposed it here on now to the hourly chart. We can see point of control from yesterday. So point of control is the point of maximum liquidity. Okay, so this is where the bulk of the buyers and the sellers are operating in terms of price. So we really want to be trading Disney on this signal when it crosses to the upside of point of control. So when it goes above this line, we get a confirmed breakout above that line, that would be the right time to enter. Now, for someone who's not sitting in front of their screen all day, this is completely irrelevant. The hourly chart makes no sense to them, because they're not going to be sitting there waiting for that break above point of control. They're not going to be doing that. That's not the way that they would operate. So what you've seen here is the way that I do it. I look at the daily, I get confirmation from a weekly, and I enter on an hourly. Pretty simple. Indicators are all the same. Okay, they're all the same. So if we decide, if someone says, no, I don't want to be trading on the daily, oh, sorry, on the hourly thing, I'm going to be entering on the day, then what they would be doing is looking at Disney and going, okay, I have some precautionary buying signals. I have some preliminary ones here. I've got a reversal here on momentum. I've got a buy calls and sell put signal here, and I've got a moving average cross. I'm trading at the 34. I'm at the second Keltner. So the trader would look at it and go, I'm either in my buy zone. So for me, my buy zone is +1 to -1. There's my buy zone. If this price was down here and I had these green signals, I would probably look to do some small trade, because this Ichimoku cloud up here is preventing me from doing a all-in kind of trade. Okay, so
Ichimoku cloud is basically, like, without all the technical stuff, it's just an area of, it's kind of resistance.
Yeah, it's an area of resistance. So you have to either be trading to the short side underneath or the long side above. So right now, there's some nice setups except for this. So I'm looking for a close above this line, right? So using TradingView, I would just put a little alert for Disney 178.33. Let's open that up. So there's my alert. So if Disney got above 178.33, indicating now it's above the cloud, I would get a message to go back in and look at Disney and say, well, are these signals still valid? Is the B score still rising? Is the squeeze still firing? Has the alpha score improved? Yes. Okay. For the next day at the open, there's a trade that's available, and it would be whatever trade. You're either doing your out of the money call, you're doing your in the money call debit spread, you're doing a put credit spread, whatever trade you want to be doing on your strategy based on the setup. But it's always about validating the signals that you receive. One trader mistake that's very common is trading on the candle of the signal. Okay, don't trade on the candle of the signal. Always wait for a confirmation of the signal on the next candle. All right, so the trading candle is actually the next one, right? Because here we've got this buy calls. Okay, what if I buy calls on this candle and the price opens now lower, like it's going to do now? I've just overpaid. I've now paid too much for that call option, even though I got that signal. So you always wait for the next candle. So the next candle is going to open up here at 176. So what that will do is it will invalidate the signal, because now we're opening down to a lower low. We're opening down below the close of yesterday's candle. So now all of a sudden, is that signal valid? No. Why is it not valid? Because this signal here would be valid if the next candle had an open above the close of yesterday and it actually closes above the high of yesterday.
So you
see what I mean?
Going in on the signal is just way riskier and way more aggressive.
There are people who will trade on the candle of the signal, and I'll be honest, I do it sometimes as well, but I size my trades small and I write down, if it pulls back, I'm going to add some more.
And you probably need a lot of other confirmations on that signal.
So for me here, I've got a positive. The green column is a positive. I've got this as a positive. I've got that as a positive, right? So I've got 4 positives here. Where are my negatives? Well, my moving average support is not very strong. I've got a negative here with the Ichimoku cloud. I've got a negative here on the alpha score. So I've got 4 positives and 3 negatives. So based on that, I could probably do a 1/4 position. I could put something in just in case I might be right. And Disney pops open and it jumps above the Ichimoku cloud and it starts going on this trend. What we've got here is Disney's not going to do that. It's going to come back to the downside. So what I can do is say, okay, that 1/4 of a position, that very, very small position, didn't work. Therefore, I can close that trade down for a very small loss and I can wait for a more confirmed signal above the Ichimoku cloud if I want to trade Disney. I mean, the problem that comes in now at this time of the year is you are going to have more trades than you have money. That's the problem. So you can't just jump into the first thing you see. It's more important to have a list of opportunities that that you want, right? That you are willing to trade. So I call it my majors, right? So I have a look over here. These are the majors, right? So SOXL, I will trade SOXL. When I get a signal on SOXL, I trade SOXL. It's one of the best sectors to be involved in. It's a triple leverage semiconductor stock, but I don't trade it with new positions when it's extended above the 3rd Keltner. This is just crazy. I do not want to trade it down here. I will not be adding to it here. If anything, I'm taking profits off option positions and buying stock. So I know that the trend will continue. I know that this trend will continue. I just don't know how far this fallback will be. Could you imagine if you bought an option here and it pulls back to the 21? Yeah, you're going to be losing a ton of money. So
you're just looking,
we don't go
for a pullback on some of these ones that are pullback and then a buy signal again for on the next leg up.
So on the hourly chart here on the right, there is my stop line, 63.42. I can move that up and move it to the hourly EMA at 64.62, and I can save it there. And you can see where that's where my stop line is. It's at the high of yesterday. You know, so if it does pull back, I'll take some more profits off the table and I'll move that money into shares. So this is the major list, right? So you've got XES, this is energy supply, guys, right? So we've got buy signals here. I had a sell signal there. I've got a buy signal here. I've got strong moving averages. So B score above 50, squeeze forming, slingshot, well, not slingshot, but it's an upside momentum here. Alpha score is at 70. It's on the dot. So this would be an interesting one to add to, right? If we look at the weekly chart, you can see that the weekly chart is moving bottom left, top right. So this would be quite an interesting stock to add towards. And this is basically what I encourage people to do, is to go through your list every day and see where your signals sit, right? So if you've already got an existing position, we use the secondary system here where you see these arrows and Bs to add to positions. We don't start positions on it, but we add to positions on that. So here we had a start position, add 1, 2, 3, 4, 5, 6. We've had 6 opportunities to add into this position here on XOP since the 27th of August.
This is part of your proprietary trend trading.
Yeah. So all of these things are, you know, the squeeze is common. The squeeze is a popular free indicator available on most trading platforms. The B score is proprietary. The alpha score is proprietary. And what we do is, and the oversold overbought is also, I've customized it a little bit. And what we do is we overlap the stochastics with our TTM, and we use the B score together with the alpha score to be able to justify the trade, right? So you've got to learn to look at these as your leading indicators. That's 1, 2. These are my leading indicators. This is a slight lag. There's a slight lag to the squeeze, right? So you've got to remember that as part of your trading. So what we do is we enter on a buy signal here, this green column, and then we add as the other signals start to come in. So very much what we try and do is mechanize things, right? Remember, we're trying to take emotion out of things. A lot of times people will look at trades and they go, oh, I'm not going to add now. I'm not going to add now. It's the wrong time. It's the wrong time to add. And it's an emotional response. People, when they say that, it's not something that they are applying some form of process to it. What they're doing is they're using oh, it's already gone up too far. I'm not going to add again. I'm not going to add again. But here you can see, even though it had gone up, right? We entered here. We're now here. There's still a valid buy signal. And there was a valid buy signal here. And there's a valid buy signal here and here and here. Because many times what clients do is they buy, let's say you've got a plan that's going to be trading. Let's say you can afford 4 contracts. Okay. And you get the signal, and remember, these buy signals, when they occur, usually happen after a period of decline, right? So psychologically, as a trader, you're like, no, it's not going to work. It's not going to work, right? Your mindset in this period here is very negative, all right? You're not looking for this. This comes up. So you go, oh, what if I'm wrong? Okay, I'm going to buy 1 contract. You buy 1 contract and the stock chops around here, chops. And your confidence, because it didn't zoom like this, your confidence is, oh, maybe I'm wrong, okay? And then you get your first indicator that tells you, okay, you can add to the trade. You're going, no, I've already bought the 1, so I'm not going to do it because it hasn't done much yet, so I'm not going to add. Then you get a second opportunity and you go, no, I still can't do it. And by the time you get your 4th and 5th and 6th one up here, these call options are way, way, way too expensive. So now all of a sudden you've missed the opportunity to build at the stage where it's important, because here you could be taking your profits off the first trade, the one that you did here, you take your profits off there and you buy another one. You just replace the trade that had capital with a trade that has no capital. You're using profits to do it now. So now you're de-risking your trade as you go on. So a lot of times people's mentality overrules a systemic decision, right? So what we try and do, we don't have the money to build trading robots, right? It's quite difficult to build trading robots with options. It's easy to do it with stocks and crypto because the trade is very simple: buy, sell, buy, sell. It's when you start adding in options and deltas and Greeks and all of these things, it becomes a little more complex. So what we try and do, what I've tried to do with the indicators I use, is to eliminate the need for cognitive thinking. All right, when the signal tells you to do something, just blindly do it. I know it sounds pretty weird, but you've got to get to that point of brain memory, or like a muscle memory. See green, do trade kind of thing. It's like a bit of a, it's quite simplistic. It's a bit caveman.
But I think it's the confidence, just speaking from the perspective of being still novice, in the sense of only been doing this a couple of years, but the confidence to follow those signals, even when everything is telling you inside you're like, this list looks horrible, is something that you have to develop.
It comes, the thing that happens is we are trained as humans to question a lot. All right, so we question everything. We question the validity. We always questioning, is the signal real? What happens if it's wrong, right? Now it comes down to one of the first fundamentals of a good trading plan is data. All right, if you haven't managed your data, so how many times did you enter a trade on that signal? How many times did you win? You can't develop trust in that signal. So you don't know how many times you win. We know from our experience that when we have this signal with this little blue diamond, the green column, together with this green dot, together with a squeeze, together with that at 70, we know from our own trading data that we record on a daily basis that we win 82% of the time. Doesn't mean we win 100% of the time, but we win 82% of the time. That's our stat for the last month.
When you find that 100% winner one, I need to hear about it as soon as possible.
I don't think you can find it. I tell you why. This is a big issue for a lot of novice traders, is that people become indicator junkies because their mindset is already on finding the Holy Grail that will give them an edge. Right? Remember, trading is about edge. So how do you build an edge to things? I mean, this is one of the reasons why my indicators are not available in the public domain. I don't put them out in the public domain. I give them to my clients because our indicators give us a trading edge. Now, whether I'm being silly about it or what, but I feel when you have a trading system, the more people who start to use the same trading system, the less effective it becomes. That's a common thing, right? So, if everyone trades the same indicator, MACD crossover, for example, you're going to lose your effectiveness, right? So you don't have an edge on that trade. Finding a trade system that's got 100% win rate, no, I don't think it's possible. Well, let me rephrase that. It's not that I don't think it's impossible or possible. I think it's a hard journey to get, because you still have to be a human hitting the keys, right? So there's still this element of human hitting the keys. So what I'm trying to do is not find the perfect indicator set, all right? I don't believe that it exists. What I think has to happen is, if you follow a standard process, you have a watch list, you have the same 4 indicators and the relationship between those 4 indicators consistently. So when I look at a stock, whether it's Google, Amazon, or Johnny's brisket shop down the road, I look at them all the same way. That's the hardest thing to do, because someone goes, oh, it's Amazon, it's not going to go to zero. It's Johnny's brisket shop, it could probably fail. And then you go back 1 quarter to Amazon's earnings in June, and you see what Amazon did. It did like a 4 standard deviation move at earnings, and Johnny's brisket shop didn't, right? So it's hard. What I'm trying to build for myself is something that constantly improves, right? So it needs to constantly improve. So I know what my win rates are. I know what my profit ratios are every single week. And I know that if I'm following my signals exactly as they come out, my numbers improve. My P&L gets better. My profit ratio gets better. All of those things improve.
Well, it's like anything. If you don't
When
standardize,
I don't,
if you don't standardize what you're doing, you can't. It's like comparing apples and oranges. You don't this trade versus that trade. You can't put them in a bin together and do any numbers.
Absolutely. I think a lot of retail traders, and this is no criticism of them because it's normal and everyone goes through it, but inherently people are lazy, right? When you watch any of these advertisements that happen on Facebook for indicator A or B or whatever, and it's like, hey guys, it's the Holy Grail, it will never lose you money kind of thing. Yeah, they will, because there's still a human being that has to push the keys, and those keys are driven by your fear and your greed, right? So if you don't track the performance of your indicators and how successful they are, under what circumstances they work, you're never going to trust it. It's always just going to be a signal on a screen. It's going to be a little green column, right? I know my indicators well enough. When we do 3,000 to 4,000 trades a year, so we've got loads of data that we record individually, and you can have 2 traders with the same indicator have 2 different results because of the human factor, right? So I track my data. I know exactly which indicators and which setups work, and I try and teach it to my clients. And if those setups are not working for them, we find the setup that works. Sometimes it's a small tweak. Sometimes it's a change of one indicator that doesn't reduce its effectiveness. It just increases its effectiveness for that trader. That's the key. You've got to customize it to yourself. So yeah, it's a journey, man. You're gonna see information every year that's going to drive your trading from one level to the next. And that's the most important goal of a trader, is to get better. You have to improve. You can't look at your trading and then blame your indicators. Like, that's crazy. At the end of the day, it's you pushing the keys, not the indicator.
Yeah, that's good stuff. I mean, because yeah, it is a definite, it requires discipline, but it is a discipline that people have to study.
This is so, it's fascinating though, when you start to realize the connection between the control of your emotions when you trade and the control of your data. The control of your data is key. Developing that confidence in your system comes from results, right? So what I say to my clients is, the first 30 days you are with me, you paper trade. I don't want to see you using real money. I want to see your emotional control. Now, paper trading, some people say, oh, it's BS because there's no emotional connection to the money and all of that. And you could bet $100,000, and if it goes wrong, you just click delete. But the thing is, you want to see how the signals print. You've got to see how the signals print and how you react to that signal. If that signal prints and you don't act on it, well, what's the point? You're not going to get anything out of it, right? So we usually say 30 days. At the end of 30 days, when you're testing your setup, so what is the setup in terms of the price positioning together with the signal? 10 of those, look at your win rates. If your win rate is above 80%, keep that in your book. Then you look for the second setup. Then you look for the third, fourth, and fifth. And by the time you go live, you've got 5 to 6 setups that work consistently. And then you trade those. And you trade those until they break. And then you can develop the next set. So I'm always testing new setups. I try and test a lot during the week in live markets. I don't like paper trading for myself because, you can crook it. When it's real money, no. I like to do just small positions, and then I'll test to see if that signal worked with real money.
Yeah, and you're not risking a lot of money on these when you're testing. You're just
$100. It's maybe $100 on a trade, $200 on a trade. But you want to see that reality. Right? There's a reality that comes into it. And then if that setup works, I take my notebook and I know, okay, in this scenario, I can now trade this combination of indicators and this setup. And I know it works because it's worked before. So when that signal comes up, I can act. I don't have to go, maybe not. You take away that sort of that arguing inside your head, and that's how you build a proper trade system. It takes work though. It's not easy.
Absolutely. Well, Chris, great stuff as usual. Market's gonna open in a few minutes, so I'll let you go.
Awesome. It's good to see you, my friend.
Absolutely, man. Well, good luck. Good luck this week with your trading, and have a great weekend, man.
Oh man, I look forward to seeing you on Tuesday, man, and all the best to you guys there. Okay.
All right. Take care.
Take care. Cheers, man. Bye.